Welcome to our series of recap videos and to our introduction to accounting course. Now in this video we are going to look at preference shares impact and how it links out the three statements. So just as we talked about the debt financing, and if you have forgotten about that or you have skipped that, please go back and watch the debt financing. There are some nuggets in there you can apply to the segment. In that same way, if we issue preferred shares, we would receive cash. I think the impact is down here, so you cannot really see. Once we issue preferred shares of 3,000, we will get cash, because that cash will come in as money, 3,000, and then that will be our preferred shares in the equity by 3,000. Our cash also would have increased by 3,000, so we will have our balance sheet balancing. If we decide to pay back 500 of the preferred shares, that is buy back that 500 of the preferred shares, we will have received 3,000 and paid out 500, so we have cash of 2,500 in our hands, and the preferred shares balance will also be reduced by that. So our cash element here will be 2,500, and our preferred shares here will reduce from the 3,000 to 2,500 because we have paid off some 500 out. Now, then again, this will also not impact income statement at all. Only the dividend will come at the bottom, and like I explained, this session is technically the changes statement of changes in equity, which ideally is not part of the income statement. That is why it is grayed out. But for the purpose of modeling, we try to add it to simplify matters. We don't want to have a separate statement as a statement of changes in equity. So we add that section to the bottom because it's pretty much going to show only dividend paid to preferred shareholders. That's why that section is there. So when we pay preferred dividend by a yield of 15%, then we will pick our preferred dividend balance times 15% becomes our 375, and that becomes the preferred dividend paid here. You realize that the preferred dividend paid here doesn't come through the net income line here, but it still showed at that same segment as a financing activity, not an operating activity, and that's why it's not up here. So you see the preferred dividend charged here, as well as the issuance and buyback impact here. And once we have paid off, we have 2,500 in our hands, we have paid off 375 as dividend to the preferred shareholders. We have 2,125 cedis as cash in our business, and that will feed our cash and cash equivalent. And once we have preferred share balance of 2,500 here, and we have retained earnings balance of 375 because we have paid out some part here as negative. Forget about the fact that it's negative, just for the purpose of illustration. We are having a balance of 2,125 balancing. Now let me hasten to add that dividend on preferred shares are determined at the point of issuance. So once you are issuing the preferred shares, you will tell the percentage that you charge as preferred dividend, just as it applies in loans, in debt financing facilities, you go for a loan and they will tell you the interest on that loan is 10%, or 20%, 30%, and whatnot. So also with preferred shares, once it is issued, the dividend element on it is determined beforehand. Whether you make money or not, they don't care. You are having a fixed yield beforehand. That is the same way as interest applies. So in our case, we have a preferred dividend yield of 15% on outstanding balance, and that is why we charged it on the balance that we have. So what I'll call this equity statement, but for the purpose of our modeling, also in our income statement. So let me summarize by saying that any issuance or buyback of preferred dividend has no impact on the income statement except when dividend is paid, and that is why it will have an impact, and even that is for the purpose of the modeling. It will come at the bottom section here, and like I explained, this section is technically the statement of changes in equity, but for the purpose of the modeling we include it in the income statement, but ideally it shouldn't be there. Thank you.